Okay, welcome everybody. We had 60 people registered. I see they're gradually coming on. I think this counter just goes at its own speed here. But anyway, well, again, welcome to today's webinar. It's being hosted by InPlay Oil. This is one of my top picks in our high yield income portfolio. InPlay Oil is a Canadian junior upstream oil and gas company that I have been following closely for almost 10 years since it was formed. And I knew Doug went his previous company, Vero Energy. One of the things I like about InPlay is their production mix, which up through the first 9 months of this year was not good because he had 40% crude oil, 43% natural gas, and 17% NGLs in the third quarter. And we all know that our gas prices have been super low. So InPlay's realized natural gas price has been down this year from an average of $3.45 Canadian per MCF in 2023 to $1.81 Canadian through the first 9 months of this year. The outlook for North American natural gas prices has significantly improved since the beginning of November due to Trump's election and the shift to colder temperatures in the eastern U.S. before Thanksgiving. So yeah, we got a pretty significant winter storm that's going to be impacting the northeastern quarter of the country that burns a lot of natural gas for space heating. So U.S. natural gas prices are now back over $3 US MCF. In fact, I'm looking at the screen right now, and the December contract is trading for $3.40 today at the time of this presentation. I expect gas prices in Western Canada to rebound to over $3 here MCF pretty soon. And in 2022, InPlay's realized natural gas price was as high as $5.37. So man, big upside if we get there. But you know, 2022 was when we had that big spike in gas prices in the U.S. in the middle of the year that went to $9. So joining me today is the company's founder, Doug Bartoli. Doug is the company's president and CEO. He founded InPlay Oil in November of 2012. Prior to forming InPlay, he was the president and CEO of Vero Energy, a public oil and gas company from September 2005 to November of 2012. He also previously served as vice president of operations at True Energy and held management and engineering roles at Husky Energy, Renaissance Energy, and Pan Canadian Petroleum. So during the webinar, if you have questions, please type them into the chat box and we will answer them after the presentation. So with that, I will now turn it over to Doug Bartoli for an update on InPlay Oil.
Thanks, Dan. It's good to be here. You know what, 2024, let's see here. There we go. Can you see that on the screen? You got the slide changed? Our presentation's on the screen, right?
Yeah, I can see it.
Okay, yeah, great. Sorry, yeah. Well, it's good to chat here with you and your group here today, and you know, I'm sure many people I've met over the years. You know what, 24 is just about over. I mean, I am constructive on 2025. You know, I'm going to talk about that. I think we're still in a multi-year energy bull cycle. There's a lot of noise out there, which we all know.
Yep.
You know, right now, you guys got a new president-elect, which you know is again, lots of noise there. So I got some slides I want to show you guys closer to the end of my presentation that I'll try and go through real quickly. But you know, we pride ourselves on trying to run a very smart junior oil and gas company. And you know, once we go through the presentation, we'll talk about how we're seeing things and going into 2025, and we'll do that throughout the presentation. But you know, again, discipline-led oil growth, developing our high rate of return assets. You know, we're focused on free adjusted funds flow and conservative leverage ratios, maximizing returns to shareholders. I mean, Exxon says pretty much the same thing, right? The focus is on free adjusted funds flow. It's on return to shareholders. You know, and I'll give you guys some quotes from some large companies in the U.S. after the Q3 reports here in the last month or so. But I mean, I'm an engineer. I've been doing this for 30-some years now, and the volatility is crazy. We've got a strong track record over 8 years. You know, like I said, 24 is over. I'll go over that forecast specifically. But what I want to talk about is we're done now, our capital program. We're done in The end of Q3, I think we spent maybe 7 million is all we're going to spend in the fourth quarter. So it's a free cash flow quarter. It's a debt payment quarter going into the end of the year. We did put in our press release, like we usually put our guidance out and our budget, our forecast in early January, second, third week in January. But you're going to see our 25 outlook is quite different. It's going to have a benefit of enhanced capital efficiencies, and we're really focused on the free funds flow next year. One of the biggest things, which I'm going to talk about more than once, is back to drilling in Pembina Cardium Unit number 7. This is going to be a significant portion of our 2025 drilling plan. Last time we brought wells on production here was May of 2022. And again, it represents the strongest capital efficiencies within our portfolio. So we drilled 4 of these wells at the end of the year. And we actually reduced our capital costs with some new drilling and completion efficiencies that we put together and some technology, and we dropped them between 25 and 30% less than what we were drilling prior. So again, that's going to be going with us forward. We spent over $20 million in infrastructure over the past 2 years. Right now, we're proposing and planning for somewhere around 10%, maybe 15% of that on a yearly basis. It's going to be significantly smaller. We don't need to put any money in. It's going to be a very smart year next year while we figure out where the commodity costs are all going. I know everybody has a different view on that, the bulls and the bears pulling away. And again, our dividend is in place. We paid it out for 2 years now. At the end of November, it'll be the end of 2 years. I know it's 10% as we sit here today. Again, we will see improved cash flow multiples at some point in time. I am still a longer bullish person on the commodity side, and we've been putting hedging positions in, and what we think are at favorable prices. So we're mitigating that risk, and you'll see us do some more, specifically on the gas side, as we move through this cold spell and getting into 2025. I mean, the year's just about over. We're going to drill 12.6 net wells. We'll be in that 87, lower 8,700 range of production. Our reserves are still our major sustainability. They're strong. Again, very clean share structure, 90 million outstanding, fully diluted 92.8, 162 Canadian market cap, 230 enterprise value at $1.80 per share. Again, and it's been better lately again. I mean, relatively strong liquidity in our stock for a company our size. So, I mean, we own 6% employees and directors, and we have that one large shareholder that's 22.6%. Net debt was 68 million at the end of September. It's going to be, give or take, 60 million, we expect by the end of the year, maybe slightly less than 60 million. Again, strong technical team. All of our bios are on our website and in our main presentation. The board, of note, Craig Golanowski is on our board. He's the 22.6% shareholder. Just as a note, Dale Schwed just sold Crew Energy to Tourmaline here for, I don't know, a few $1 billion. I think it closed in October sometime. So good piece of business for Dale. So really strong, experienced board members. Our production graph, our reserves graph. I mean, I've talked about this over and over. You look at production. That was our growth since we went public in November of 2016. We light green is our oil and NGLs, orange is our natural gas, the blue box is our production per share growth. And again, I don't believe it's always about growth. It's about maximizing value and the return to shareholders. But if you continually and over time grow your production per share, you'll grow your reserves per share, and it's not all done with debt, you will create value for shareholders through these cycles, because we are a very cyclical industry, as you all know. And I've been doing it for a long time, and the volatility these days seems to be second to none. I mean, adjusted funds flows on the bottom left corner. Again, maxed out at, what is it, 4,000 barrels or 5,000 barrels in 2019. That's about 32 million in Canadian, right? And then we went to 50 million Canadian in 21, all the way up to 130 million in, my 30 plus years, the best commodity price in this industry, or $1.50 a share. And again, pricing's been down and some small drops in production through the next few years. But in the meantime, we've dropped our leverage, bottom right corner, from 1.9 down to 1.6 prior to COVID, and all the way down to 0.2, 0.3, and it would be kind of 0.6, 0.7 with the commodity, or 0.7, 0.8 with the commodity prices and where we sit this year. And we'll talk a little bit more about that on the 2024 forecast page. I mean, reserves are a year old. Again, strong reserve value. I've said before, and historically, you traded closer to a total proved case. These days, we trade, a lot closer to a proved developed producing case, which is a blowdown case of just your current producing reserves. Again, we've been very efficient over the last 3 years. On the left corner, the blue squares is what we're finding our proved developed producing reserves for. 3-year average, we've been finding that for $12 and some cents per BOE in the ground. That's number 2 amongst a group of oily weighted peer groups that we consider relative to trade publicly. So we're number 2. Number 3 year on a total proved. So total proves adding some undeveloped locations that the reserve evaluators give it a probability of 90% hitting. That's up in the $13, $14 per barrel range. So again, been very efficient in finding and adding reserves. And along the way, some of that's been done with some very smart accretive acquisitions, which again, I'm going to talk about some more. Most people have seen this quite a bit. 85% of our production comes from the Cardium. Up in the north is the Pembina Cardium unit. Down in the Pembina Cardium, down to the south is Williston Green. Williston Green is where we've put a lot of money in gas infrastructure facilities and takeaway capacity in the last year and a half. But we've also added facilities up here as well in Pembina, predominantly on the west side here, a little bit in the Belly River on the far east side as well. But again, this has been our focus the last part of this year, and we're tickled with the results that we're getting from PC Unit 7. So, I mean, Willie Green, Pembina, the center of this area, the Alberta map, 2.5-hour drive just north of us, northwest of us here in Calgary at our head office. I mean, very, very old oil patch. You can see all the vertical wells that were drilled, started in the 50s and 60s, and, vertical wells were drilled into the 90s. Water flood put in place in the best part of the reservoir, and then of course horizontal well completions with multi-frac completion technologies took over. And again, this area has been around for 70 years, and it's going to be around for another 60 or 70 years. So we talked about acquisitions. The acquisition we did in Q4 2020 in Southwest Pembina from Arc Resources. Probably the best acquisition that I've done in my career, probably one of the best acquisitions I've done, or many people have done in this industry. We actually got it finalized in October of 2020. I mean, WTI was in the mid-40s US at the time, 190 barrels, taking that thing to greater than 4,000 barrels. Again, it's going to be a key focus for the next 24 months. So if you take a look at this production graph, we got it closed in October. In the first quarter of 21, we started drilling, a little bit of optimization there, bringing on wells that they had shut in or didn't bring on with COVID. And we started drilling. We brought 3 wells on the end of Q1. We built a full facility there in the first quarter to coincide with all the new production we're bringing on. We drilled 3 more wells in June, came on the end of July. All told, the $1.9 million acquisition, the facilities, the 6 wells, we had this acquisition and all the capital costs paid off by the end of September in 2021. And then you can see we continued to drill. Our last 3 wells came on in May of 2022. We were going to start drilling that fall, but we saw some issues with third-party gas plants and production coming up and pressure backing off, and we actually got curtailed here in February of 2023. Majority of that came back on after about 6 or 7 months, but we still haven't drilled in 23. We didn't drill in 24, specifically because, again, we recognized we'd probably have a weak gas price in 24, and that's why we drilled 4 wells coming into the end of this year with what we perceive to be better gas prices coming, and of course they are. And I can tell you, like, I expected Q3 gas prices, summer and Q3 gas prices to be in the $1.20 Canadian range, not the 65 cents we got in the third quarter of 2023. Ultimately, $1.9 million is what we purchased this for. This property is free cash flow of $57 million. We've increased the reserve values to $68 million at year end and 108 on a PDP and a 1P basis. 66 times, 87 times on a 1P basis. Again, just a spectacular amount of value creation that we did on this acquisition. Now, Prairie Storm, which we closed in November of 2021, that's a bit more of a, what you would think of a normal acquisition in this industry, but it really filled in our land base in Williston Green. We did put a lot of capital into this. But again, 1,800 barrels a day. We grew it again up to 4,000 barrels and then up and down a little bit, but a lot flatter, a little bit of a growth trend going into the end of the year. 40.5 million for this property. Free cash flow is just -10. You got to remember, we probably put about 15 to 18 in here over the time frame of infrastructure, so quite a bit higher than we did in the other unit. But ultimately, 2 times on a PDP basis over 4 years, 6 times on a 1P. Again, strong value add. And I'll say, like, we normally, we had a tougher time. We haven't got any deals done since then. We normally do our best work when the prices are a little bit lower, and you seem to get a better bid-ask spread when the buyers and sellers and some people having to sell at this lower price environment. I think the opportunities there, and I think, people that can actually take advantage of it are going to create some significant value if you can get some deals done in this next little while. So yeah, I commented this. PC Unit 7 is this red block in our map. We have not drilled in here for 2.5 years. We have secured a long-term, what do you call it, priority 1 access to a gas processing facility, and it has allowed us to now start drilling in there. And it's going to be a big chunk of our drilling for the next couple of years. We historically materially outperformed our type curves. We were consistently killing it on our guidance when we were drilling in here. So we're tickled that we're back in here in the fall. You can see the curtailment, you can see our production declining. We're able to flatten it out a little bit through this year with some optimization projects and some figuring out how to do some great optimization work with artificial lift in horizontal wells. And then you can see what's occurred since we brought our 4 wells on, all the way back up to 3,000 barrels. So, expectations are somewhere close to 70% of our drilling next year will be in this area. So again, a couple things about the wells in this area. They tend to have lower decline than some of our areas. It's got a little higher gas production in this area, which is part of why you have lower declines. The gas increases a little bit, even though the oil still stays nice and is one of our highest oil-weighted operations, which again lowers our decline and allows us to show nice growth, but very, very capital efficient area. And again, I think I mentioned before about the cost structures. We knocked the costs down pretty much 30+% on those first 4 wells in near perfect conditions that we drilled it in the spring or in the fall. Williston Green, again, not much to say here. We increased the gas plant capacity, doubled it from 8.4 to 17.3 million. Put a lot of infrastructure capital into the area to be able to continue to drill and do activity in this area. Again, it'll be an area, lots of locations that we'll be worried about and drilling through the next and upcoming years. Just economics really quick. Let's focus on 1.5 miles on Pembina Cardium. If you would have seen our presentation prior to the quarter, it was 3.95 million. We actually brought those wells on for around 3 million, 3.95. They were about $3 million in Q4, Q3, Q4. We're saying 3.4, being a little bit conservative going forward, but still dropping 500,000 off per well on this is good. It's always a little more expensive to drill in the first quarter in Canada with the weather and the cold conditions. Everything slows down a little bit and costs a little bit more to run. But bottom line, still some pretty good payouts, approximately half a year at $70 WTI. And again, that will be the focus over the next year. 24 is getting close to being done. Looks like we'll average $76, maybe give or take for the year. Again, Edmonton par, that'll be about $98, right? I've said this many times. We got the benefit of paying for all of our services and people in Canadian and selling our oil in US dollars. And, I think we'll average 73, 74 cents in 2024. But guess what today, as the oil's at $70, our dollar's under 71 cents. And, I think, potentially has, because we'll have to probably drop interest rates quicker in Canada than the US, probably will go below 70 cents and, we'll get a 40 to 45% bump on our sales. So still pretty good sell prices. AECO, significantly lower. Probably compared to our start of the year, what strip was doing, probably lost about $1.30 a GJ there. And just as a note, like as of next year, or you're very close to this year, but like $1 above that, we get $2.30 a GJ. That equates to about 9 million extra of revenue from our gas. So if we get $2.30, that's 9 million, and the costs are the cost there. The only thing that comes off of that extra 9 million is royalties. The rest of the costs are pretty standard. We talked about a few pieces through there. 70 to 73 million in funds flow. The capital program was 63 million. Our sustaining capital with the little bit of facilities, the high efficiency drilling in PC Unit 7 to sustain our production to this year is about a third less. Want to do a little bit of growth, we're predicting it'll still be 25 to 30 million less. That's 20 some million dollars that'll go to our bottom line in 2025. We don't have to drill 12 wells in 25 to maintain that production because of drilling in PC Unit 7. So again, we're looking forward to 25 with what we've got in front of us, and a very, very efficient type program that we expect to put out. And it'll have optionality. If prices increase, we can make changes as the year goes on. But this year, you can see our hedging working for us. I mean, plus $5 US WTI, we get 1.1 million if the year's just about over, extra in cash flow from our forecast. And it's actually, if it goes down $5, we only lose 700,000 because our hedges are working nicely for us. I always like to show a few little slides. So this is a company out of the UK. It's a nonprofit organization. I mean, why to be bullish on oil and natural gas? I found this and I like this slide. And this goes back all the way, continuing more focused in the Industrial Revolution and into the 60s and 70s. But it's good to know we're still 80% energized in this world by fossil fuels. They converted everything to million BOEs of oil equivalent, whether it's wind, solar, and everything. But oil, still growing since the 2000s, still growing since 2010. Natural gas, significantly nice angle on that growth. Coal flatter, which it should be. It's just a good chart to tell you that the energy transition isn't working the way they'd like. Global population growth drives energy addition, is what it does. So this is a slide. I know people have lots of questions. What's going to happen? It's a busy slide. Let's start in the top left corner. Iranian crude production. It was 3.75 million. A little bit of sanctions and infighting with them and the Obama on trying to get nuclear under control. But before Obama's term, let them back up to 3.75 million. Well, and then we all know what President Trump did, brought it down to 1.8, 1.89 million. And the Biden lack of sanctions, well, sanctions were still in, but the lack of actually enforcing those sanctions added over 1.5 million barrels of Iranian crude that pretty much got sold to fund all their proxies, predominantly in the Middle East. Great policy. That's probably coming back. So we're going to see that. We're going to see somewhere north of 1 million to 1.5 million barrels probably shift off the market. Unbelievable gasoline demand for the U.S. this fall. Back to work restrictions are less and less. Amazon's telling people to move back. Office space in New York is going back to very less and less office space. But bottom line is the gasoline demand's going pretty good. We all talk about, and I know Dan showed this, and I know Curry has put slides out about this, OPEC plus spare capacity. There's no doubt it's overstated. I mean, it's quota-based capacity. I mean, it's no different than when we know there's apportionment in pipelines. We overstate what we're going to sell because we know we're going to get cut back. They're doing the same thing, right? There's no incentive for them to maintain production capacity if it has not been called. Like, you're not going to spend the capital on new oil to maintain capacity. They've been letting capacity drop. Top corner here, you're looking at inventories. They're low everywhere. Global, floating, U.S. commercial, Canadian. We're at the bottom end or below the 5-year averages. And I mean, here's some AECO look back to 1998. This is an Alberta government piece. But 2025 strip is greater than 270% higher than our Q3 average at 65 cents a GJ. 26 is 400% higher. Again, we all know what's going on. I mean, LNG Canada will start producing next year. That's another 1.8 BCF in Canada, 10% of our production in Western Canada. That can double quickly. And there's a lot of LNG going on in the States. So we should see much better views of the AECO price. And I know I've talked to Dan, and he's got even a higher view than I do.
Well,
drill,
Doug,
baby,
hey,
drill.
Yeah, drill, baby, drill. Hey, Doug, I interrupt you for a minute. I posted about a 45-minute presentation by the head energy guy with Raymond James, and he goes through all these inventory things, and he says it's kind of like the oil traders are totally ignoring how low these inventories are. All petroleum products, crude oil, diesel, gasoline, they're all at the bottom of the 5-year range. And like you said, unless it's population growth that drives demand, and on a days of consumption, if you measure OECD inventories on days of consumption, this is his pet peeve. It's how you should really be measuring inventories, not on like looking back 5 years. Well, heck, the demand was a lot less 5 years ago. And he says on days of demand, oil should be like 110 today. And anyway, the link is on our forum if any of you guys listen want to see it, or send me an email or something. But it's a really good piece by him. Anyway, go ahead. I'm sorry.
Yeah, that's great. I mean, you know, like you can see that little red line in Q4. Like, that's the lowest quarterly gas price we've seen well, since in Canada and since the 80s. And like Q3 was a little bit better than that, or Q2, but not a whole lot. Like, you know, and you can see where Q1 was like massive drop in our gas price. Like, anyway, I mean, there's no doubt it looks better. It needs to be a fuel of transition, a choice. So, I mean, everybody has their view on it, but I mean, there's no doubt it should get better. It should get more consistent. You know, and I hope we see a floor that we never really go. You know, before the floor tended to be at $1 once in a while, but I'm hoping that becomes a $2 or a $2.50 on a Canadian price, and probably it's, you know, $2.50, $3 on a U.S. price is more the floor, right? Because climate's or weather's a big part of the equation there, which is hard to predict. But bottom line is we're going to need more and more power here.
Well, I was talking to somebody from API a few years ago, and he said, you know, when we get our access to the global market, when this LNG export capacity gets up to like 20 BCF a day or something, then more and more our gas price is going to be determined by the global price, and the global price are for gas. Natural gas is trading for like $14 today in Asia and in Europe. And it just costs like $2.50, $3 maybe to freeze it and, you know, transport it over to those markets. So if they're buying U.S. gas for $3, put another $2.50, so $5.50, let's say they got in it, and they're selling for $14 in Europe and Asia, they're making a killing on those LNG cargoes. So that's going to keep going. They're going to be running at capacity as high as they can get because there's so much money at stake in that. Anyway.
It's all good. I mean, you know, and we know you guys got a new president coming in, and probably most people on your in your forum are happy about that. And
Yeah.
again, it's probably a good thing as we move forward. But I mean, drill, baby, drill. Okay.
Not gonna, yeah, not going to work like he thinks, but yeah.
This is U.S. This is U.S. shale producers. I don't know why it says share. Little typo. It's funny to see after
Shale.
the fact.
Oh, okay.
Q3 commentary committed to free cash flow return to shareholders. Consolidation of growth names, like which were the private equity backed private companies which were proving up reserves and increasing production massively for a sale, are being sold to free cash flow return to shareholder focused companies. Chevron, we will begin to shape our profile there in a little bit of as a plateau, and we'll really begin to focus on free cash flow. So growth will become less of a driver. They're speaking specifically of the Permian. Exxon,
Yeah.
the focus of that team is maximizing net present value. It's not a volumes game here, it's a value game. And the good news is we see a lot of value. Diamondback, someone's asking a question about this, right? I don't know why the discussion of growth or multi-year growth needs to be in the equation. Diamondback has learned that our growth impacts the macro market, and we are focused on the macro here. I have said over and over, like, why am I growing into a potentially, if everybody believes it, which seems to be the case right now, into a huge macro market? I don't need to. I need to focus on strong capital efficiency, free cash flow, pay my dividends until things turn. Core, for each of the next 3 years, the plans to maintain flat pro forma 24 production, right? Like,
Right.
No growth, right? But does that change? Yeah, sure. It changes on commodity price. But I mean, drill baby drill is going to put oil to $55.
Yeah.
These guys,
the only thing that's going to make
they're losing all their that would be losing all their motivation to drill.
Yeah.
Right? Like,
the only thing that makes drill baby drill is higher oil prices. Period. They're not going to increase. Every one of these is saying they're not going to increase their drilling program unless we have higher oil prices, because it's only then we'll have more cash flow to fund drilling. But yeah. So they'd be stupid, and so would OPEC Plus would be stupid to overproduce so they can lower the price of what they sell. I mean, that makes no sense, right? You know, there's no sense to this. So anyway,
it makes no sense, Dan. But OPEC Plus is different, right? I mean, these are national country-run oil companies, and they need that to fund their budgets, and they have sizable prices required for them to have break-even costs. Each of those countries is different, so these are public traded companies that are telling you what their focus is. Their focus is free cash flow, return to shareholders. You'll see more consolidation of these big companies, and there'll be the few privates that are left at some point are going to run out of, like, they're going to be selling, and there'll be less and less privates that are showing growth. Oh my gosh, I'll think of it. Quantum was on CNBC, the president of Quantum, who's funded a lot of U.S. shale companies down there. They believe they're out of Texas. And he was on CNBC, and he says, yeah, we're seeing the end of what we are seeing, the ability to buy things and grow in the Permian. Like, that side of the business is gone for them.
Mm-hmm. So, and really, outside of the Permian, there's really not that much more upside for oil outside of the Permian. So I think I'm seeing a lot of analysis that thinks the U.S. oil production is going to peak here at, maybe we're at 13.5 or something million per day oil production. Maybe we get to 14.5, but then that's pretty much going to peak, and that's it. And IEA, which is totally misstating demand and overstating supply, understating demand. You start looking where they think this supply is going to be coming from. Brazil's having problems. U.S. oil production is kind of flat. Where else is it going to come from? I mean, actually Canada is one of the places where there is some uptick in supply. So anyway, well, go ahead.
Yeah, I mean, IEA, the other one is, which they're already backing down. If you read the latest pieces from the president, Burrell, they're already changing their tune because they've hugely overstated the transition, and with who's Trump's put in and the threat of reducing funds to them, they've already in the latest commentary from them have changed their tune significantly. So I always call it the great, for the world, the great energy think tank based out of Paris, right out of Paris. Great.
Yeah, right in the middle of Paris, where they know who signs their paychecks. So anyway, all right, you ready for questions?
We're kind of coming to the end. I mean, again,
okay,
you know, 24, you know, it's behind now. Like we are in a great position. Like I say, with what we got planned going into 2025, starting with continued drilling in PC unit number 7. Again, I can't tell you how excited I am to be continuously drilling in there. You know, our preliminary forecast, again, we mentioned in our press release, it's delivering focus on free cash flow, proving the capital efficiencies, very minimal capital facility infrastructure is required. We've got some cost reductions in our drilling program, which we think we can take right across all of the Cardium play. You know, and I think, you know, as we come out, but you know, we have mentioned this, like our sustaining capital is going to be 25 to 30% less than 24. You know, again, stay flat capital would be 30+% less than last year. So that provides a lot of cash flow and optionality with that cash flow. Like I said, you could drill more if prices were up. Again, we have one of the lowest leveraged debt to EBITDA ratios amongst my peers. Love to take advantage of some opportunities that present themselves. We've done our best deals when prices were a little lower and everybody was potentially when some people are getting a little antsy. And we're starting to see that. We're getting some private equity backed companies that are, again, been around a long time and looking for some liquidity. So it'll be an interesting year from that. So yeah, we want to be positioned to be opportunistic, and you know, we're going to have a good year in 25. So that's predominantly it.
Okay. I think you've addressed some of these questions that were sent to me, but I'll go ahead and read them anyway. But one of our guys, who I know owns a lot of your stock, he's an InPlay, currently pays dividends at 1.5 cents Canadian per month for 18 cents a year, which is about a 10% dividend yield based on the current share price. Does the company have enough free cash flow to sustain this level of dividends? And I think you addressed that.
Yeah, and I mean, you know, again, that was the commentary about how we're setting up for 2025. You know, just the capital spending is, you know, some probably 20 million shorter, right? And I mean, that's the other thing. Like, you know, we were expecting to be kind of 66 million for the year in capital this year. Just those reductions in costs in our last 4 wells had us exit the year at 63 million in capital, saying is what we'll be closer to. So again, setting up ourselves for a strong 2025, and it, you know, basically trying to address those issues, right? And that comment, that question.
Well, if you're going to have more free cash flow in 2025, would you consider stock buybacks? Starting for stock buybacks then?
Well, maybe. You know, I guess it's always been an opportunistic piece for us. You know, it's not our favorite way to do things. Like, you know, again, I would rather be investing in smart accretive acquisitions over share buybacks. Yeah. Ultimately, like, it's funny, like share buybacks, how do you say it, are, you know, at some point in time, you know, people will never remember the share buybacks, but people will certainly remember, you know, if you were able to do all the right things and maintain your dividend and through some ups and downs and increase it when things are good. So, you know, it's there. It's a lever that we have, but we haven't used it too much.
Well, you know, as a shareholder, I would say, you know, if you got extra free cash flow, pay down debt, number one. Number two, drill more. If you got areas you could drill wells that pay out in 6-8 months, let's drill more of those. You know, build up the reserve base and stuff like that, because that's where you're going to get more recognition. I still can't believe that, you know, you're among several of the Canadian juniors I follow it's amazing how low these multiples are to be, profitable companies, free cash flow, paying nice dividends, and you're selling for PV10 of just your proved reserves. It's crazy. It's just crazy to me.
Proved producing reserves, not
I
even.
know, proved producing reserves. That's what you're trading for, and you have to double the share price, triple the share price to get just the proved reserve. That's amazing. Because basically, when a stock is trading at a PV10 value, that's present value of that production less debt divided by the share count. You're basically saying you don't think the company's going to drill any more wells or develop any more reserves. You think they're just going to blow down, just produce the wells they've got. That's basically what the market's telling you. I don't know. It's crazy.
Well, you got to remember, I mean, our base in general is a high retail oriented base, which is like the majority of us small caps. Like there's very few institutions in the space, and if they are, they're in much larger, much liquid names. That's part of the reason for potentially getting bigger is you do start attracting some different type of shareholders, but that's the biggest key is we're not seeing that, and your retail base, I mean, just about every one of my junior peers, there's only a few that are in the positive territory this year. So I mean, we've got probably a little bit of tax loss selling going on as well right now, which should end here in middle before Christmas anyway. But I think it started early, so usually when it starts early, it ends early in December. But we got to get through that now, and we're ready, reset and ready to take off again in 2025.
Hey, to get to the low end of your guidance for the year, production guidance for the year, actually, don't you have to average about 9,500, 9,500 for the fourth quarter to get to that. So is that still the target to get to? Well,
I think 8,700, somewhere between 9,350 and 9,500. Yeah.
Okay. So with that, your drilling program next year, are you going to kick off drilling in the first quarter?
Oh yeah, we have to.
Okay.
Just based on the nature of our business in Canada, but it won't be as big as the other first quarters for the last few years. But just due to the nature of our business in Canada, you got winter, frozen ground, and then you got frost coming out. And depending on the weather, if it's wet and cold and doesn't dry out very quick, you have a tough time moving equipment through a big chunk of the second quarter. So if you don't drill in Q1 and you don't start drilling until the end of June and into July, you're declining down pretty hard.
But so if you're going to drill 12 wells next year, you're going to drill like 3 or 4 in the first quarter, not much drilling in the second quarter because of spring breakup, and then finish, do the same thing you did this year, probably finish most of your drilling by the end of October, right?
Yeah, I mean, typically Q1, Q2 is a free cash flow quarter. Is this Q1 spend? Q2 is a free cash flow quarter. Q3 is a spend quarter, and Q4 is generally a free cash flow quarter. But I don't think we'll be drilling 12 wells next year, 12.6 wells. We'll be drilling more like 8-9 wells next year.
Oh, that's what you need to maintain. Okay, good. Anyway, you still have the Duvernay shale stuff, right?
Yep.
Okay, is there any chance you consider some kind of joint venture there, selling that or anything?
Well, selling it's tough based on the landowners around there. We've had some opportunities for a while. There's who owns the majority of the land, the property around us. I mean, we have looked for joint ventures on that play before. You got to have higher oil prices and sustained oil prices and a belief that it's going to be longer. It's going to be higher for longer. It doesn't have the same returns as our more conventional plays. So I mean, there's one company just to the northeast of us, 45, 50 miles. They just sold to privately. And then I know the company around us potentially has someone looking at a sale at the appropriate time too. So, I mean, things could change in there quickly. we've been close to getting some partners at times, but kind of like doing acquisitions with the volatility in the oil price. You start here and you drop it here, right? In any type of private equity and people that put money into those plays, they run everything on strip pricing, Dan, and right.
The strips in, when the strips in backwardation, it's hard to do it, especially in those high cost areas. I know. Can you go back to the slides where you show how many drilling locations you have at Pembina and those two. I think you want me to ask. One more. Yeah, this one. And I call this running room, and you can see over there in Pembina that you got 147 net horizontal drilling locations, and so you're only drilling 8, 10, 12 a year. You got a lot of running room there, and then Williston Green, you also have a lot of running room.
Correct. Yep.
So tons and tons of good inventory at the current rate of drilling. So that's good. That's a good thing. Can you talk about your balance sheet a little bit? Where do you stand on the leverage ratio and what your debt is right now? Is it all just like on your credit line?
Yeah, we have Canadian lenders in our credit facility. Like I said, we ended the third quarter with the capital spend about 68 million, and it should be below 60 by the end of the year, give or take what final commodity prices are doing. So we'll drop it back down, which gives us about 0.7, 0.8 times, again, depending on the final pricing.
Let me see if there's any more questions here. All right. I think your well level economics look good. I think we've answered pretty much a question. I 7 or 8 questions that were emailed to me and they were all pretty much the same. I mean, the one I didn't specifically ask. What was the oil price and gas price? How low would those have to be before you'd have to cut dividends?
Well,
oil went to 50 or something, right?
Well, yeah, I mean, you got to put the two together.
Yeah, that's right.
And again, how long does oil go to 50? If that's the case, like, I mean, for every bear, there's a bull, but, again, it just seems like a different time. Again, OPEC Plus doesn't do them any good to let it go to 50. They've worked too hard to keep it higher, and they need higher. And again, to 50, I mean, what do the U.S. shale guys do, right? I mean,
they shut down their drilling project like crazy. Well,
if you put the two together, like, then you got a double whammy, right? So we always said $55 for a short period of time is no problem, but that was also a 2-something gas, like not $1 gas. But I mean, again, gas isn't going to be $1 next year. It looks to be significantly higher. Colder winter, bigger draws on inventory, LNG Canada starting, more LNG operations in the US. So, I mean, we've had record draws for this time of year here in Canada the last little bit, and a significant amount, a couple times here in the last few weeks, 8 BCF a day going down to the US. I mean, that's just on a daily basis. So that's pretty big numbers. Throughout the year, it's probably more like 5.5, 6 BCF a day, and a couple of times in cold spells it's been over 8, but not this early in the year. We've been 8 BCF a day going down south. So
yeah, well, I've got gas price forecast from Raymond James, HFI research up there in Canada, and they're both. Even Raymond James is saying by the second half of next year, as we head into the next year, they predict that gas and storage next summer is going to be below the 5-year average with the winter approaching. And when you have that situation, that's when we get these bidding wars between the utilities, LNG exporters, and whatever for physical supply. And both of them are saying, Raymond James, $5 gas, HFI saying like $8 gas. And if anybody listens to this, if you email me, I will send you their report. You can read it, and they go into the detail about how they come up with this high price, because they're saying that the numbers don't balance. I mean, with LNG exports going up year over year by 5 BCF with Freeport back online, because remember, the first quarter of last year, Freeport was offline. So if you take that 2 BCF a day plus the new 3 BCF a day from the 3 new facilities that they've built, you're looking at a big increase in our LNG export facility. So, and like I said at the opening, that's the one thing I'm really bullish on InPlay for, because you do have, some leverage to the gas price. So if the gas price goes up $1, that's a significant increase in your free cash flow. So, which insulates you from.
Yeah, and that's why I say, like, are you going to get both of them low together? Like,
Yeah.
Probably not, right? You're going to have one or the other, cycling through through it all. So, if you get the two of them working together, like that's how you got, like I say, Q2 in 2022. I think we got 134 Canadian for our oil, and we got close to $7 an MCF for our gas in that quarter. It was like the best quarter I've ever been involved with in this industry. So, I mean, you know me, and I've said this to your people and I'm not a big fan of 120, $140 oil, because that's how you go back to 50.
Yeah.
And I'm not a big fan of $8 gas, because that's how you go back to $2
Two.
right? But again, in Canada, $2.50, $3 gas is great.
Great,
right?
Yeah.
I mean, in the US, that number, or $3, $3.50, is going to be the same type of stuff. And I mean, it's hard to fathom that we don't start getting more into those numbers. I'm sure you're going to get spikes up to $4, $5, $6. But typically those spikes are, sort of they're weather related.
Yeah, I brought up a 25-year chart of gas, and when you go back to before we had the big ramp up in shale oil, where we get all this associated gas, basically they're willing to give away. They're willing to just sell their gas for nothing because they want to produce the oil. Before that, we had a period of like 4 or 5 years where oil traded, or natural gas in the U.S. traded between $4 and $5 for about 4 or 5 years. And I think that would be, once LNG exports really ramp up to like 20 BCF a day. We're at like 17 now. So a few more of these facilities come online, we get a big access to the global market. Then I think you could see maybe the base price in the U.S. is like $4 gas. So if you put $4 gas in a lot of these forecasts that I run, you're looking at some serious free cash flow for a lot of these companies. Because like all of our Sweet 16, the lowest one is Baytex, and they produce about 30% of their BOEs are natural gas. But you got other ones in there, it's 50, 60, 70% of their production. It's only like 20% of their revenues, because they get most of their revenue from oil sales. But on a BOE basis, a lot of these companies produce a lot of gas. So anyway,
well, I mean, and $4 gas in the US should be three and a quarter in Canada, give or take, right? Should be more like the base number, right? So, I mean, that's another, we're $1.33 this year. I mean, that's $2. Like for me, at 24 million a year, that's pushing 18 million extra of revenue, which the majority of that goes straight to the bottom line, right? Because it's
awesome.
All the bills are paid for, right? So.
Yeah. Hey, there's a question here. What is the payout ratio?
Well, today, I mean, this year will be slightly over 100%. And I mean, that's why we always had that nice clean balance sheet to get through a few interesting times. But I mean, if we go into next year, and my math is right, and $70 oil and kind of strip gas prices, it's going to be back down to 60%, give or take.
Okay. All right. Well, that's all the questions we have. Hey, thanks for doing this. And we are going to publish an updated profile of you after I get back from vacation. I'm going down to Mexico for the first week of December. But when we get back, you guys are at the top of our list for publishing a new profile on it. And anyway, it's good. We got a lot of members that own this stock. I know you're coming to Houston here for some meetings. So good luck with that. We got beautiful weather down here right now. Even, what, the one good thing about the hurricane season, when it's over, then the weather's really nice with low humidity and everything. It just takes all that humidity with them or something. I don't know. Anyway. All right. Well, take it easy, buddy.
Thanks, Dan. Pleasure.
Okay. Take it easy.